So who determines price? Good morning, options traders. For this video, you're going to have to get your thinking caps on. We're going to do a little different tack than we do from normal videos, but I think it's an important concept for traders to understand who determines the price. Now, to kick things off, I want you to jot down your answer and tell me, who do you think actually is responsible for the prices that we see in the market, whether it's the shares of stock or the options that you're trading? Who determines those prices? Now, I can already do a little mind reading act because I can tell you what your answer is, at least for most of the people out there. They're going to say it's the market makers, right? We've all heard that. The market makers take prices up, then they're going to take things down like they're puppets on a string. Well, that's absolutely not true. As I've talked about in previous videos, the market makers simply balance the supply and demand. Now, yeah, we might say that the market makers report the prices, but they don't determine the prices. If the market makers put any price on the board outside of supply and demand, they're actually harming their own profits. They have no incentive whatsoever to just kind of make up prices and try to make them artificially low or artificially high. That is a complete myth. Prices are determined by the market. However, within this market, there's a small group of traders who are responsible for the price that you're seeing on the board. And these are called the marginal pairs. Probably never heard that term before, but it's an important concept. And as we're going to find out, it's really 4 traders at any given time who are responsible for the prices that you're seeing on the board. Now, to make this a little more fun, we're going to use a very old, I think it was back from the 1800s, from an Austrian economist, back when they were doing a lot of the history of economic thought and trying to figure out questions like this. Austrian economist by the name of Eugen Bombauer. How's that for a name? But this is what he came up with, and it was called a horse trading model. Back in the day, horses were really in popular demand, so he was imagining that you are having an auction. And we have a lot of buyers, people coming up with no horses, but some money. And we have a lot of sellers, people coming up with horses and no money, trying to swap them out for cash. And so the question is, if we have, let's say, an auctioneer who might be taking the place of our modern day market maker, how is he going to set the price? Well, let's take a look. So what we're looking at here are the groups of buyers and sellers. We have buyers on the top, we have sellers on the bottom. And these prices that you're seeing are prices that exist, let's say, in their heads. This is what they're willing to trade for. Now, the first thing to notice is that we don't have an equal number of buyers and sellers. And that was done intentionally to dispel another myth. When people say you have to have an equal number of buyers and sellers, they think that at any given moment in time, you have an equal number of buyers and sellers who show up, and that is definitely not true. That's a misinterpretation. So even with this group, we can still find out what is a fair price for a horse. So the first row right here, what we're looking at is these are, let's say, prices that exist in these traders' heads. And this first guy says, I'm willing to buy if I can get a price of 300 or lower. Right? If you're willing to pay 300, you should be willing to pay less. Now this next person in line isn't quite as aggressive. He says, I'll buy it, but only if I can pay 280 or less. This next guy shows up and says, I'm willing to buy if I can get it for 260 or less, and so on down the line. Now, the way that we read these and kind of the terminology is to say this is the strongest buyer. When we use the word strong, we're just meaning it's a bigger price. So this guy is the strongest buyer, and they're getting progressively weaker as we move through the quotes this way. Down on bottom, we have sellers. Works the same way, just in the opposite direction. This guy shows up with a horse, says, I'm willing to sell for 100 or more. Right? If I'm willing to sell for 100, I'm not going to complain if I end up getting more. Somebody else shows up and says, no, I'm not going to let it go for 100, but if I could get 110 or more, I'll let it go. Somebody else shows up with a price in mind of 150, and so on up the line. So we read these the same way. This is our weakest seller, and they're getting progressively stronger as we move out in this direction. So right away, this is exactly how a market is set up. We have buyers or bidders on one side, we have sellers or the offer prices on the other. So the question for our auctioneer here is, what should be the market price? What's kind of a fair price for this horse? Well, let's take a look. First of all, let's dispel another myth where they say, oh, the market makers are just going to put whatever price they want to on the board. So let's see, let's put $1,000, right? If we believe the myth that the market makers just take it up and that they take it down, why not? Let's go for the big guns. Let's go for $1,000. Guess what we walk home with? Zero. All right, so there's no reason in the world for the market maker to just start picking prices. The market makers have to work with the prices here. So in our example, it's the auctioneer. So he's going to say, well, what if we try to go for the highest person here? Now again, yes, I know these are prices that exist in somebody's head, but let's say the auctioneer had a pretty good guess at 300. So he says, you know what, I'm going to post the auction price here at 300. Well, what happens? Well, you've got one buyer, that's this guy who's willing to pay 300, but you've got 8 sellers, right? If the price is 300, the person who shows up willing to sell for 100 is certainly going to say yes. So is the guy who's willing to sell for 110 all the way up to 260. All 8 of them are going to raise their hands and say, yep, I'm willing to let it go. Well, we don't have a balanced market. See, this is what we're talking about when we say a balanced market, not who shows up. Again, I've got far more buyers than sellers, but that doesn't mean I can't balance the market. But right now, a price of 300 is too high. It's inviting way too many sellers and not enough buyers. So what if the auctioneer says, well, what about a price of 280? Now we've got 2 buyers, the guy who's willing to pay 300, obviously he'd be willing to pay 280, and the guy who's willing to pay 280. This guy's not willing to buy, he's only willing to pay 260. So we've got 2 buyers, and we still have 8 sellers. Far more sellers than buyers. Market's not in balance yet. So the auctioneer says, well, what about a price of 260? Now we've got 3 buyers, and we have 8 sellers. Still not in balance. Auctioneer says, what about 240? Now we've got 4 buyers, and we have 6 sellers. Notice we've knocked 2 people out of line. These people were only willing to sell if they could get 250 or higher, or this guy was willing to sell at 260 or higher. But if the market price is set at 240, they're saying, you know what, we'd rather keep our horse. So they drop out of line. Now we've got 4 buyers and 6 sellers. Still out of balance. So now the auctioneer says, what about a price of 220? What happens now? Now we've got 5 buyers and we've got 6 sellers. We're getting closer, but still the price is a little high. When prices are high, it encourages sellers, and that's what we're seeing here. We've got more sellers than buyers. So we know the price is too high. Auctioneer says, what about 210? What happens now? Something interesting happens here. We flip. Now we've got 6 buyers and 5 sellers. See, at a price of 210, this guy now jumps in and says, yep, I'm willing to buy. If the price is down at 210, you can include me. So we get number 6. But we've knocked this guy out because he was only willing to sell for 215. And if the price is 210, he says, not going to sell. So now we're left with this guy selling at 200. So now the price is too high. So see, there's this back and forth motion until we find a price where we can balance the market. Well, if these are the prices that exist in everybody's heads or in an options market or a stock market, if these are the bids and offers that people are submitting, what does a market maker do? Well, a market maker is going to realize that the price has to be set somewhere within these 4 prices. So it's got to be greater than 210 to knock this guy out, but it's got to be less than 215 to knock this guy out. So maybe somewhere in the middle at 212. And if he sets the price at 212, we've got 5 buyers, 5 sellers, and in this case, our auctioneer has maximized the amount of revenue he can put in his pocket. So kind of interesting. Price of 212 puts more money in his pocket than a price of 1,000. See, again, that's why it's absolutely wrong to say that the market makers just take prices up or down. They don't. They are responding to what the crowd is posting and all of the flurry of orders that are coming their way. So these 4 traders right here in blue are called the marginal pairs. And it's really the interplay between our weakest of the successful buyers. Remember, weaker means a smaller price. So these first 5 are all successful. They walk home with a horse, or maybe ride home with a horse, but he was the lowest price. But he also has to kind of be balanced against the strongest of the unsuccessful sellers. Because if we put the price too high, we would bring this guy into the mix. And then we also have to consider these two. The price has got to be bigger than 210, and it also has to be bigger than 200. So it's these 4 people who are creating the prices. Now, another way to see this is that of the successful buyers and sellers, we know the price has got to be greater than 200 and less than 220. But these people over on the unsuccessful side are also saying we can tighten up that range. 200, 220 is a 20-point range. We can actually do better. We can predict that the final price will be somewhere between 210 and 215, even though these people are left out. So it's these 4 people who determine prices in the market. Now, here's where it gets really interesting. If you change any of these other prices, let's change this one to 400, we'd still get a balancing point of 212. Let's change this one to 290, or to 270, or to 286.45. Doesn't matter. We're still going to balance at 212. Do the same down here. Change any of these. Change this guy to 112. Isn't going to make a bit of difference on our 212 final price. But you change any of these 4 in here, and price is going to change. So kind of an interesting look that when you are trading in the markets, it's really these 4 people, what are called the marginal pairs, that are really determining the price. So now you can see why if this guy right here knocks his order out or cancels it and changes it, the price is going to change. That's true for any of these 4 in blue, but not true for anybody else. So just keep that in mind. It's the marginal pairs who determine the price. And that also sheds a lot of light on why you can see big changes on the implied volatility on your bids and offers, why stop orders can get triggered at the mark, even though it looks like the price didn't move. Or it could just be that either of these traders changed their price and it changed the midpoint and it triggers your order. So kind of sheds a lot of light on how sensitive the market price can be. Okay, so let's jump over to what is more of a modern layout for, let's say, an options quote. We've seen this before in previous videos, but over on the left we have the bidders, the buyers, and notice we are going from the weakest to the strongest here at the top. And over on the right we have the asking prices, or the sellers, and we are going from the strongest to the weakest. So right here, the inside quote, what you're seeing when you pull up your broker's platform is the strongest bidder, that's where this 310 quote is coming from, and the weakest seller, that's where this 320 quote is coming from. But make no mistake about it that there were traders on the other side of these bids and the other side of these offers. So let's say that somewhere in the world somebody was willing to pay 325. Well, he got filled. He was a successful buyer. He was willing to pay 325, but the price was only 320. So that price got crossed and he's out of the queue. Over on the right, somebody somewhere in the world may have been willing to sell for 305, but he could get 310, so they get knocked out. So all of these traders who would have appeared up here when, let's say, the market first opened, and all the traders down here were successful. We don't see them. What we're left with are the unsuccessful ones. But the point is that at any given moment in time, it is the strongest of the unsuccessful bidders coupled with the weakest of the unsuccessful sellers. But then to complete the marginal pairs, to figure out who also determined these prices, it was these 2 in blue. It was the weakest of the successful sellers, right? There were people up here at 350 and 4 and 5. They all got filled. So he was the weakest of the successfuls. And over here, he was the strongest of the successful sellers, because there were people down here at 3, 290, at $1, but they all got filled. He was the strongest of the successful sellers. So it's 1, 2, 3, 4. Those 4 traders are responsible for that quote right there. Everybody else has no bearing on these quotes, and that's because they are not the marginal pairs. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.